Chapter 21. This is a continuation of the subject of capital investments. Chapter 20 covered the basics. Chapter 21 covers some advanced topics with how do we manage risk and how do we actually make selections. Topics for this chapter are sources of the risk and uncertainty, and then how do we deal with that? The two ways that we can deal with it. First is choose a discount rate that is appropriate given the level of risk of that project. Second is to look at ways to analyze, evaluate, and flex the projections so that we could test the limits of the model and quantify the risk. Fourth is how do you make the choices? How do you balance all the considerations? Some financial, some strategic, some regulatory, some perhaps based on the resources inside the company. And finally, how do we monitor, measure, and review the results after the projects are done? The comic on the right says, I thought I was interested in uncertainty, but now I'm not so sure. A little confused, this man. All right, so let's move on. Sources and responses to risk. The sources are many. The project itself inherently has some risk. There are assumptions, there's uncertainty. We're not sure of the variables or the quantities that may be involved. Secondly is competitive risk. We cannot necessarily anticipate the moves by our competitors. We need to consider that because it's relevant to our markets and how our customers perceive us. Third is the industry at large might have risks that we are a part of. Global risk exists because we may and probably have some global connections either in the supply chain or in the value chain. Geopolitical risk. We're in a world, unfortunately, of fair uncertainty on geopolitical basis, and they may impact some of our decisions and actions. Then there's the financial market risk. We're in the context of a larger economy. The debt market, securities market, all have impact on every company, some more directly than others, but nonetheless, no one is immune from the changes in the financial markets. And finally, there's estimation bias. We know the nature of the person making the projections might have some bias either way. They may want to sandbag and lower the expectations. They may be naturally optimistic, or they may be trying to sell the project by purposely making it optimistic. All these are possible behaviors that we see with individuals acting sometimes in their best interests. So how do we deal with it? We have two ways that we can address this. The first is let's use an appropriate discount rate. We'll go through what that means and how we might quantify that. And secondly, there's a series of things we do to analyze, evaluate, and maybe flex the budget a little bit to see the limits and the exposure that we have on given projects. Topic 2, the use of an appropriate discount rate. The discount rate, as we've seen, has a major impact on these discounted cash flow methods. Changing a discount rate dramatically can change the NPV. It could flip from being an approved project to one that no longer meets the requirements. Also in the IRR, if the IRR from the project is less than the desired IRR for the project, then it won't get approved because it's substandard. So discount rate is very important for the evaluation of projects using any of the discounted cash flow methods. So our goal from a finance standpoint is let's pick a discount rate that is commensurate with the risk taken on by that project. And you have an array of, say, 10 projects. Those 10 could have completely different risk profiles. Some are high, some are medium, some are low. Some are consistent with the business of the company currently. Some are departure from the business currently. All of these enter into our assessment of the risk. One of the places we start as a benchmark is the weighted average cost of capital. You'll probably remember that from your finance class, but the weighted average cost of capital considers, as the name implies, all your sources of capital: equity, debt by way of bonds, and debt by way of loans. Furthermore, it's weighted. It's weighted so that if we have most of our financing from stock, we would tip the rate toward the requirement of the stockholders. If it's more financed by debt, we would tip the percentage calculation toward the debt rates. So the weighted average calculation reflects the cost of capital and also the proportion of where the sources come from, debt or equity. We use that as a starting point because in general, the companies is expected to meet or beat the weighted average cost of capital. And if we fall below the weighted average cost of capital in our return on invested capital, we're going to pay some consequences because we will disappoint the market. So we often start with the WACC. It doesn't mean that every single project should use the WACC. In fact, that would be a bad thing to do because of what I said. If we had a project that is the average risk for the company, that should be earning a weighted average cost of capital return. If we have a project that's higher risk, we should not give it a low rate of return. We should give it a higher rate of return. The graph that we see on the right kind of depicts how we might do the setting of the appropriate rates for different projects. This first bar on the left, the blue portion represents the WACC that is computed for the company, independent of any projects. The little red piece on top is a premium to give us a little buffer so that we are going to underwrite our own projects based on a slightly tougher standard so that we have a little headway, that if we miss by a little bit, we're still clearing the weighted average cost of capital percentage. Then each of these green bars represent specific projects. One is a low risk and equipment project, which just extends the capabilities in a factory. That's pretty low risk. We know how the factories work. We know what the machineries do. So therefore, this is fairly low risk and might be even charged a rate below the WACC. It seems a little odd, right? But the WACC captures the average for the company, and at any point in time, we may have some projects over that rate that are riskier. We may have some below that rate that are less risky. And here we have a couple that are in the less risky variety. The first one is low risk equipment. The second is replacement products. We already have a track record of products, so as we're extending or changing the product slightly, we're pretty sure of a success. Then as we move to the right, we're getting to riskier and riskier ventures. One is a new product. We don't have history, so there's obviously risk when we have no knowledge. Next is new technology, even harder. So we have new technology, probably a new product as well. And finally, new markets. We have no familiarity with the markets. There may be some surprises awaiting us because of cultural factors, legal factors. Maybe the tastes and preferences in new markets do not match what we're accustomed to. So this arrays from low to high for these green bars. And the weighted average cost of capital plus the premium is a guidepost. So notice that the green bars do not reflect any one rate. Each one has a rate that is commensurate with the risk that is undertaken in that particular project. All right, so that's how we would set the discount rate. And there's a lot of judgment involved because we would have factors such as execution risk. For example, new product, that's a risk, right? Can we execute on delivering a new product to the market on a timely basis? The other is market risk. We don't know markets in terms of, say, entering the new market itself. That would be a major risk for our fifth project on the right. And cash flow predictability. The most stable one is the one where we're managing cost. So equipment, that we have certain expectations as far as the productivity, that's a pretty narrow band of variability. We're pretty much sure what we're going to get. Very different from when we're moving into new products, new technologies, or new markets. Number 3 is the analysis, evaluation, and the flexing of our financials. This is to measure the strength of our business model and also to see the sensitivity and the financial risk if things don't go exactly as we plan. So we always start with the base model. And we want to make sure that the model includes all the variables that we plan to push and pull. These dials that we're going to be testing, we want to make sure they're explicitly included in the variables so it's easy to do and easy to track. Just a minor note here is that in Chapter 20, I modified the results of this exact project. You might remember the medication or the pill for procrastination. There were some technical errors in it. I fixed. So for this chapter, I'm just going to go with the author's spreadsheet because all the analysis was based on this one base case. Now we're going to go into some specific ways where we can quantify the magnitude of the risk. The first and most commonly used is sensitivity analysis. In its pure form, you look at one assumption and you vary it, and you see the impact of changing that one variable on your objective, which is usually a number like profit, cash flow, or net present value. This particular graph that you see here is a little fancier because we have two measures that we're flexing simultaneously. One is revenues, so we'll test different scenarios for revenues, and then simultaneous with that, we're going to vary the development costs. This particular method is clever because now we can quantify the relative risk of moving one or both of those options. We see in blue the base case, and we also see pretty clearly that the revenue assumption is very sensitive. The range going from 88 to 154 at one level of development cost shows almost a 2x amount of variation. Whereas if you look at the development costs at whatever revenue, it's less than a 20% change. So the sensitivity analysis here clearly shows that the revenue assumption is the one that's most sensitive. Surprise, surprise. The one that's hardest to guess at, which is revenue. But that makes sense because revenue drives the entire ship. If we're having some issues delivering on our revenue estimates, we're likely going to hit some tough waters. So this is one example of using a sensitivity analysis across two dimensions simultaneously, where we can go plus or minus a certain percentage or dollar amount and then measure the impact on the NPV. The second variation on sensitivity analysis shows that we can then, instead of arraying a whole series of percentage changes, we'll have less degrees of changing as far as percent variation, but notice that we have 6 different variables. We have sales, cost and expense levels, tax rate, the initial outlay, the terminal value, and discount rate. All of these are variables that are important. So instead of varying it across a range, as in the prior slide, this one says 10%. So we have a base case, then we'd just change it by 10% to the detriment. So sales being lower, expenses being higher. We're really testing the strength of the business model. Then after we have that percentage change, we then see what impact did that have on NPV. And what we see pretty clearly in the yellow highlighted rows are that the variation in NPV in dollar terms and in percentage changes is highest for the cost and expense levels, and then also the discount rate. So those are the ones we have to watch out for quite carefully. Discount rate reflects what we're just talking about when we're discussing WACC and a project risk. The ones that were least damaging were the initial outlay and the terminal value. These did not change the outcomes very much in terms of NPV. The others are in the middle. Tax rate and the sales are in the middle. Of course, they have some impact negatively because we're reducing the amount of profit of those scenarios, but they're not as dramatic on the downside as the cost assumption and the discount rate assumption. On the far right, we have a break even, and this means what value must this variable have in order for NPV to equal 0. So it's not break even from the standpoint of profits, it's break even from the standpoint of NPV equals 0. The reason we picked that point is that that's the point where if it goes a little bit to a lesser NPV, it goes negative, all of a sudden it's not accepted. So it's right on the edge of being acceptable. That's what we did here, calling it the NPV break even. So this is another way to show sensitivity analysis. It's not better or worse than the prior. It does show more variables and the impact of what 10% might mean, but it doesn't have the breadth of movement that the first one has. So maybe you do both. The next approach is to do scenario analysis. As we've discussed in prior classes, scenario analysis is where we put together a whole series of things that fill around a story. The story might be, in this case, we have a failure and we abandon. If that occurs, a whole bunch of things are unblocked in how we would deal with a failure. Another is the competitors enter with a product. If that were to occur, it may spur some things on our side, maybe reaction on the pricing, or change in the production level, or maybe change in the promotion budget. And then finally, we have revenue and recession options that could have some upside effect on this as well. So this particular approach, a scenario changes more than one variable, and there's a story around each of them. Here, of the 4 scenarios, the one that shows the most amount of risk is a failure or an abandonment of this project, and that collapse, right? So that makes sense that it's the highest risk with the highest downside impact. The others are not as dramatic in terms of the change in the NPV. However, they still outline possible things that occur, and as we've discussed before, scenario analysis leads to good forethought on what would happen if. So regardless of how the numbers work out, just the articulation of these scenarios is a valuable exercise. The next approach is to look at event trees. This is similar to what we showed for decision trees, and except here we're tracking what will happen or what may happen. Similar to scenario analysis, we're branching on different points of the rollout or whatever the project entails, and we're assigning those split off points and also percentage probabilities of what is a high side scenario, what is a low side scenario. In this exact example, we're working with a product. We're launching a new pharma product. So the first thing is let's embark on some testing. First of all, it costs us some money. So there's a $20,000 price tag for testing. Then there's the first split. Was it successful or not? If it's successful, we move on. If it's not, we'll kill the project. If we move on, there's the split of, is it a high side scenario, a base case, or a low side scenario? Then we'll work out what is the cash flow and NPVs for those 3 scenarios out for the planning horizon, which goes through 2025. Then we can calculate the NPV. And since we're doing it pretty rigorously, every node has a probability of the branches that come off of those event trees. If we multiply across all the percentages as we trace the nodes through to the endpoints, the multiplication of all those percentages is the percentage of that specific endpoint. And here we see that the probabilities are 14, it's over here, 14, 42, 14 again, and 30. They must sum to 100%. Every time we do one of these expected value type calculations, it has to equal 100%. And we multiply the NPV by that percent. And this number on the bottom right-hand corner is our new expected value. Notice that it differs from the expected value from the base case. Base case was only 25. But what's happening here is the upside is so spectacular that it's pulling up the expected value above the base case scenario itself. So event trees are useful, again, partly to articulate what are the branches that may occur, also to force you to think through probabilities of different outcomes that may occur at each of those nodes. A variation using trees is a real option. I really like the concept of a real option because it's a point of view that you can pause, catch yourself, and see if you can modify the design of your process to incorporate a real option. I've just made up a very simple example to illustrate the power of a real option. Let's say in choice number 1, you have a product and you launch it and you invest $1 million, and there's a 50-50 chance that it's going to succeed. If it succeeds, it's going to be a $5 million success. If it's a loss, you're going to lose the $1 million. So 50% times 5 million is 2.5. 50% of $1 million loss is a loss of 0.5. So the expected value is 2 million. Not bad. You put in $1 million, you expect to make another $1 million on top of it. Let's try scenario 2. So instead of launching, let's do a small launch on the test market and then see what happens. Let's spend a smaller amount of money since it's in a test market. Let's say $300,000. If it fails, then we abort. If it succeeds, we've learned from that test, and that will actually increase our ability to then go to a full launch. So in addition to managing financial risk, we're actually gathering information so that we can pivot a bit on our launch strategy and perhaps increase our successes. So in this case, that full launch then has different odds. It has, in this case, a 90% chance of success. If you've succeeded in the test, tweak it further, and then roll it out to a bigger launch, we'll assign a 90% probability for a successful launch after your test. So you multiply across the kind of small launch, big launch success leads to an outcome of expected $2.7 million. The sequence of small launch, big launch, and just break even yields a $0 contribution. And then the small launch and abort the effort leads to a probability of 50% of a failure where we lose 300,000. Notice we didn't lose $1 million as we did in the full let's go for it approach. We lose 300,000. When you add up the expected values from those probabilities, we end up with an expected profit of $2.55 million. So by simply designing the sequencing and rollout a little more carefully, we can increase the probabilities and also increase our expected profit. So real options are very powerful. In normal speak, anytime you have the ability to put a little bit of money out to get some feedback instead of putting all your money in at once, just logically, that's going to make more sense. Well, what we're doing in real options is formalizing that a bit, but the idea is the same, is if you can take a little bit of a move and then have a point to assess and maybe a break-off point where you can abort at that point, that the combination of small dollars and the ability to get out of the decision, both will serve you well in terms of expected profit from a project. Next is, well, how do we select the project? In this particular case, we have a dozen projects, and senior management has a very straightforward, financially geared metric. They're saying we're capital constrained, so profitability index is important because you'll recall that PI means that for every dollar of investment, how much do we get in future cash flows? And if I'm maximizing that, I'm going to get the ones with highest leverage of capital. So my cap is used in the best possible way. Here, pretty straightforward. We array from 2.0 down, and these are the projects that get approved, and we're accumulating the total to make sure we're staying within our overall capital budget. But life is not that easy. So let's look at one a little bit more complex. So this is where we have balanced criteria. It's still the pharma company, and in yellow, I'm showing where we're torn, where we'd love to go for the money, but we have other considerations we need to be careful about. First is wastewater treatment. That's an EPA requirement. I don't think we want to be violating federal law. So even though it has a negative IRR and a negative NPV, for us to stay in business and in good standing, we need to take care of it. So that is number one on the list. The next one is a new roof. Again, it has a negative IRR, negative NPV, negative PI, but the FDA will come and that might jeopardize our FDA approval. That's not something a pharma company can toy with. So number two priority is stay in good standing with the FDA. So far, we're not making very much money. The next one is a drug for the procrastination. This is one we've been playing with. This one has high strategic value. It's a new product in a big market. And despite the probability that it's not the highest profitability index, it has a couple of things going for it. First, it's strategically important. And you'll notice the blue here, accretive. This is another finance word. What the heck is accretive? Accretive means that your EPS will rise. Often this word is used when we talk about mergers. When two companies come together, sometimes the end result is accretive on the acquirer, which means their earnings per share would rise as a result of the acquisition. But sometimes, actually quite often, the acquisition of a major company may actually dilute your EPS for the short term. In this case, we have a situation with this new drug where it's both accretive in EPS and it is strategically important. So that's why it's quite attractive. Next one, again, we're looking at strategic importance and picking another loser in terms of profits and NPV. And then finally, we're starting to get some projects. We look at number 6. We have a positive NPV. I don't know why an airplane is a positive NPV. I suppose all the deals that they're going to make that are successful. And then before we kind of run out of money, we also have project number 11. And that one is replacing building 2 equipment. And that's kind of the classic good investment. We're just upgrading the longevity and the performance and reliability of our equipment. So overall, we're going to have an IRR of 25%. So it's still very positive. And the profitability index is positive, but that's a mixed bag because some of them were negative. So this is a good example of reality setting in where we have all these finance tools and we arrayed them right here with NPV, IRR, PI. But when it comes to making decisions, we know that there are other things that are more important than money, strange as that may seem. The last step is we have a project, it's approved, we're underway, and it's either done or still in process. But we want to measure all the actuals as it's underway so that we can make sure that we can help, if possible, get it done in a positive fashion. Here we have a mixed bag once again. We have some completed projects as highlighted in blue here in the second column. And then we see what happened. Well, we had some variances that were not particularly favorable. So although they're finished, it's not exactly successes. On the right side, we see 3 projects that are in red. Each of these has fairly substantial negative NPV outcomes. Negative 125, negative 380, negative 1,185,000. This is crying for attention. So the notes here are cost overrun delayed, review needed. The next one is design delays, review needed. Next one is on schedule but competitive product introduced, review needed. So this is kind of the signs are going off, the red flags are going off. Let's see what's going on. So this is a good example of having a set of projects that it's not like, okay, we approved it, I signed the authorization, I'm moving on to a golf game. No. After we approve it, in some respects, the work really starts because now we're implementing against that budget on a project plan. And we want to make sure we deliver like any project on time, on scope, on budget, right? Even though it's easy to say, those are hard things to do. On time, something always goes wrong. On scope, we think we know how it's going to work, but along the way, things might happen to make us alter the scope. On budget, this is what we're looking at here, is were we able to stay within the financial parameters that we proposed and that was approved. So this is an important function, not a pleasurable review because there's going to be three pretty difficult conversations. So summarizing chapter 21, we identified the sources of risk and uncertainty. We can't get rid of those. They are reality. So we have to deal with it. How do we deal with it? We could factor that into our decision making so that we choose the ones that have a good risk return trade-off. We do that by picking the appropriate discount rate. Then there's a whole set of things we do to manage the projects from a financial risk standpoint. So we can pick projects based on the level of variability in the returns. And once we see the variability, we can create scenarios that hurt us so that we could plan in the event they do occur. What is our action plan to mitigate or eliminate the possibility of that downside scenario? And then when we look at decisions, we sometimes can branch them and create a structure called an event tree. And that will help us look at the things that may occur, assign probabilities, and get to some statistically based measure of what we expect to happen. An offshoot of that was the real option, where we could perhaps structure the project in a way where we can hold back some cash and see how things unfold before we step in with more money. The other aspect of real option I didn't share is sometimes things go well, and instead of going forward with your plans, you actually double up your resources. If you have a test product and it doesn't do okay, it does spectacularly, that doesn't mean you just do what you thought you were going to do. Now we have positive reinforcement. We may be able to go even harder and generate even more profits. So real options work for abandoning projects that aren't panning out, for keeping some of our powder dry, that the cash is not yet expended, and to then mitigate downside or to take advantage of upside opportunities. Then the fourth topic was on the choices. How does a company actually allocate scarce resources, namely money, across the many of, let's call them many worthy projects? And we saw two, kind of one very extreme one where you just went by the numbers, and the other one where you clearly integrated what's happening strategically with your business and also to keep in good graces with the government and regulatory agencies. And finally, always remember that the approval is just the beginning, it's not the end. After the approval, we run the projects, we try to deliver the projects, and then we're monitoring it. And at the end of the projects, we'll just, as we should for everything, have a review and a feedback session. What went well, what didn't, and that will inform how you make decisions in the future. Just good practice. Again, sometimes painful, but it's an important process to maintain the momentum and improvements inside of a company. All right. Thank you, and see you in class.